Hi, it's John Kelly. In this module, we are going to discuss ISA 720, which is about the annual report. And it's an alert because this new section may have a significant impact on the audit reports of not-for-profits and private enterprises. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now this is ISA 720 revised, and it was just released, and it's effective for periods on or after December the 15th, 2016. Though there are possible delays both internationally in Canada and in the United States and possibly elsewhere. Now there are some differences between the old and new standard. It's mostly unchanged in terms of the procedures we do, but there is more detail in the standard. But we are still basically reading the document for inconsistencies if there are any, and then responding to those inconsistencies. There is an added documentation section, which was probably implicit before. We are to have a copy of the report that we read, and we are to document the procedures that we did. Now there's a bit of confusion on what comprises the annual report, and I'm a little sarcastic when I call it other information, but kind of have to call it other information because what constitutes the annual report could differ in different situations. So that's why it's called other information, but it's a little confusing. The biggest difference is the effect on the audit report. And these changes are coincident with the new and longer audit report that is coming on the same effective date eventually that this one will come on. Now, the impact on the report. This section applies whether the entity is listed or not, and it applies whether or not we have all of the information for the annual report before the audit report date or not. And there's a little exception for other than listed entities, which we'll talk about on the next slide. The bottom line is you're going to have to mention the annual report one way or another in the new, longer audit report. This slide shows the impact on the audit report depending on whether the company is listed or other than listed, and depending whether all or some or none of the information is available. If all the information is available, you mention it in the report, and there is an example. And this is the same for listed or other than listed. If all the information is available, it's mentioned in both reports. If only some of the information is available, it is mentioned in the audit report of a listed company, and it is also mentioned in the audit report of an other than listed company, an NPO or a private enterprise. The wording is not identical as it is if all the information is available, but it's similar. If none of the information for the annual report is available and it's a listed company, it is mentioned in the report and there's an example. And here's the technicality. If it is an other than listed company and absolutely none of the information is available for the annual report at the time the audit report is signed, then there's no mention in the report. And that's based on a very careful reading of 72021. That means that if it's an other entity and no information is available, there's no mention in the report. The problem I have with that is it could be very difficult to determine that absolutely none of the information is available, because that's the only time you're allowed not to mention it. And if a teeny tiny sliver of the information is available, and the auditor is unaware of that, it must be mentioned in the report because some of the information is available, and you then have to modify your report similar to example 3. Now here is one of the many examples that they have in the standard of how this will affect the audit report. And this is an example for a listed entity where none of the information in the annual report is available before the date of the audit report. And we will always have these 4 or 5 paragraphs, sometimes there's a 5th, And they're always going to be pretty similar, but they'll change. And I've got another example that's coming after this slide, and we'll see the changes depending on the circumstances. So a statement that management is responsible, and then a statement of what the other information comprises, in this case an annual report, but that it does not include the financial statements and the auditor's report. And then the annual report is expected to be made available to us after the date of the audit report. And then a statement that we give no opinion on the annual report. Our opinion on the financial statements does not cover the other information, and we will not express any form of assurance conclusion thereon. And then we describe our responsibility, which is to read the other information when it becomes available, because in this circumstance it's not available yet, and consider whether or not it's materially inconsistent with what we know from the audit. And then we say when we read it, if we conclude that there is a material misstatement, we will be required to communicate this to those charged with governance. Here's a second example. Other than a listed entity, some but not all of the information is available, and this could, for instance, be our small not-for-profit, where some of the information that comprises the annual report is available, but not all of it. So similar first paragraph, management is responsible, and then we tell what we have got to date. The other information obtained at the date of the audit report is the chair's statement. Now, I don't know quite what that might be, but presumably we know for this client that that constitutes part of the annual report, or what will become the annual report. But again, it does not include the financial statement and our auditor's report. Then the same paragraph as in the other one, our opinion does not cover the other information and no form of assurance conclusion. And then in connection with our audit of the financial statements, responsibility is to read stuff, look for material inconsistencies. And then this is a different sort of paragraph. If based on our work that we have performed on the other information prior to the date of this audit report, we conclude that there is a material misstatement, we are required to report that fact. And then we have nothing to report in this regard. So something like that one or the previous one are going to be required in probably almost every audited or audit report. And we might want to start letting clients know about this. So things to do: follow the implementation date closely. It is probably going to be later than December 2016. Follow the guidance on the wording closely. The wording may change or revise or evolve, or more examples may be provided, so watch that carefully. And then I think the most important point is we need to start thinking about advising our clients. Some version of this wording will appear in almost all reports, though many reports are going to be lots longer. So some process for advising clients that suddenly your audit report is going to be printed on 2 pages as opposed to the one that it's on now. Now, the reason that I've amended this presentation is I've done some more thinking about what clients are affected. And public or listed entities are clearly affected, and they are now. So that's no change other than, of course, a much longer audit report. And with a public company, you have some safety because you know they're issuing an annual report. And it's normally issued at the same time and on the same date as the audit report. So the auditor normally withholds signature on the audit report until they have had a chance to read and clear the wording in the annual report. So we're kind of okay on that. And with all clients, it's useful to have an engagement letter paragraph where the client says, we're not going to issue an annual report, and if we do, we'll let you read it before it's given out. And that we'll first give you the annual report and we'll fix it if we have to. So those are useful things to do, and we can be relatively safe now. Now the problem becomes with private companies and NPOs, because the definition of the annual report is very, very broad. It includes almost anything the client does to explain the annual operations to almost anyone. And so any document or documents or combination of documents for stakeholders, not just shareholders, but stakeholders, and that would include the bank or funders of a not-for-profit, sort of anyone, any document like that with information about operations is considered an annual report. And the client has to give it to us, and we have to read it and clear it ahead of time. And we have to mention it in the audit report. So as I think about this, I think almost all not-for-profits will do that because they will provide reporting to funders or to members or something that will constitute an annual report, and therefore the auditor will have to mention it. Private companies, I'd initially thought they wouldn't be much affected, but if a private company has decided to have an audit, they're much more expensive than other things they could have done. It's probably because someone, banker probably, is looking at their financial statements, and the banker will be expecting to receive a report on operations, which probably meets the definition of an annual report. So I'm kind of thinking now that almost every client that is audited will issue something that meets the definition of an annual report, and therefore we will have to have that key audit matter paragraph in every audit report. And it's only required, there's an out here perhaps for auditors, if we have some of the annual report information other than the financial statements, because it's the other information we're looking at, not just the financial statements. So if we have some of it at the date of the audit report, we must include the KAM paragraph. And I suppose that's a note for the auditor if someone later criticizes the auditor and say you didn't have the paragraph. And then you'd say, well, we didn't have any of the annual report information when we signed our audit report. Though, of course, subsequent investigation may find that there were some bits of it. And if there were some bits of it, then you should have included the KAM on the annual report. So there's some issues. Should we always include an annual report KAM in every single audit on the expectation that if they're getting an audit, there has to be some stakeholder out there to whom they are reporting? Do we always include an engagement and rep letter paragraph where the client says they won't issue an annual report unless they give it to us and tell us about it at the audit report date? Though the problem with that is if the client honestly forgets and doesn't read that paragraph or doesn't understand it, the auditor could end up in trouble after the fact. And the other thing, I suppose, a stakeholder might complain and say, hey, we got an annual report, and you didn't mention the things that you were supposed to have done on the annual report in the audit report, and that's a criticism. And then I guess the other problem, and this goes the other way, is so now we have included the annual report key audit matter paragraph, but there are other key audit matters that we don't refer to, and can we be criticized for that? There were 5 key audit matters, and you only mentioned the annual report, so you should have included the other 5 or 6 or 7 or 8. So I worry about this becoming a key audit matter race. And by that, what I mean is the risk of missing a key audit matter is a much greater risk to the auditor than including a key audit matter that really quite doesn't rise to the definition of a key audit matter. So I worry that there's going to be a race to see who can have the most key audit matters in their audit report. Because once you start writing a long audit report, making it a bit longer probably isn't that much of a problem. The other thing is a key audit matter is basically determined by the auditor's professional judgment. And it's more than just an audit area that has high risk of material misstatement. It could be moderate RMM, or it could be just an area the auditors worry about. So just high risk of material misstatements, key audit matters are going to be much more than that. And of course there's safety in key audit matters, and they're based on auditor's judgment. And we will certainly be criticized by inspectors and others if we have too few. And it will be hard to criticize us if we have too many. If there's something that kind of isn't a key audit matter, it will be very difficult for an inspector or someone else to criticize us for including it, because we would just say, well, based on my professional judgment, I thought it was a key audit matter and I provided disclosure. And of course, if a key audit matter comes to pass, and this is where auditor safety comes in, for instance, we talked about going concern and advised people that it was a problem and future events would resolve the problem, and the company becomes not a going concern, and someone says, well, why didn't you tell us? We would say, well, we did. We told you. We warned you of that key audit matter, and that will be something that will be useful in the auditor's defense the more key audit matters we have, which is why I worry that they're going to expand exponentially. So, thanks for listening.